Good day, and welcome to Ranso's Weekly Wraps. I am Verb Govender. This week we're going to cover the US Fed minutes, South Africa's inflation rate, as well as the possible change in our inflation targeting, and finally move on to the latest news on Intel, including the possible 10% stake that the US government might take in that company. So let's look at the US Fed minutes. So for those that don't remember, in the last Fed meeting, we had two dissensions from the consensus, which was to keep rates unchanged. The dissenters wanted to cut interest rates. Now, this is an unusual event. Two dissenters is something that hasn't happened for 30 years, or just about. So it's a very unusual thing to happen. Remember, there's multiple Fed meetings a year, and for 30 years in these multiple meetings, we're talking like quite a number of meetings, we've not had two dissenters. So this is obviously an important event. What the market is looking for in the minutes was whether or not there was more broad support for these two dissenters than might have been otherwise seen. So there could have been maybe people that were like 60-40 in favor of keeping things unchanged, but they had like a 40% possible move towards cutting. That would have been quite positive for markets, because if interest rates are cut, it's going to be quite positive for stock prices. Remember, I told you many times that there's only two things that consistently, predictably change stock valuations. One is taxation, the other one is interest rates. Lower interest rates generally lead to higher stock valuations. Unfortunately, it seems that those two dissenters were effectively outliers. There was not broad support for not broader support for a rate cut. There was not as much fluctuation among the other members of the Federal Reserve. Generally, the belief was that keeping rates unchanged was the right thing to do. Now, from my personal point of view, I think there is an argument to be made for cutting interest rates at the moment in the US. The reason being is quite simple. We see inflation in the US, the last core inflation number, a little high, but not significantly higher. Overall inflation still below 2%, below 3% rather. And yet we are seeing some signs that the US economy is under pressure. The jobs numbers that we saw over the last few months, the revisions and so on, 250,000 less jobs than had been reported or predicted over the last 3 months. We are seeing signs that, for instance, in the GDP number we are getting, that this number is a bit juiced up by things like AI. To give you an idea how important AI was in the last GDP number, it had a bigger contribution to the GDP growth rate than the entire consumer sector. The consumer sector in the US is about 2/3 of that economy. 2/3 of that economy did not grow by as much as the AI spend had grown in the last period. So if you take out the AI spending from the last period of US GDP, and you're going to get a significantly lower number. Now, you put those things together, inflation not as a bigger problem as you think, and some weakness in terms of US growth rates as well as US employment, that justifies a rate cut. The one thing I would have to say is that I think Trump's kind of public spat with Jerome Powell is kind of backfiring. Now, I'm not saying Jerome Powell sits there and thinks, how can I mess around with Trump? I think in his mind he's perfectly unbiased, but everyone's human. And I do think also he does believe that if he cuts when he's like 50-50, the market might believe that he's bowing to Trump's pressure. He'd probably cut if the argument is like 80-20 to cut. But if it's like 50-50 or like say 55-45, he might just say, hey, this is not the time to cut. Just because it might, feed into the perception that he's bowing to political pressure, which he doesn't want to do. So, like I said, the minutes not supportive of market prices. Next, moving on to our own local inflation rate. So, I want to just bring an idea thing here. The last inflation number we had from South Africa was 3.5%. To give you a bit of history, we used to have a target of 3 to 6% as our range. If we went above 6% persistently, we'll cut. We'll cut interest. We'll raise interest rates. If we went below 3%, we'll cut interest rates. The Reserve Bank has moved that to effectively a 4.5% target, so halfway between 3 and 6%. 4.5% is now the target. They want to possibly bring it down to 3%. This latest number we had was 3.5%. So, under the current system, not a problem. We wouldn't want to be basically raising interest rates. We might even be thinking about cutting interest rates. At a 3% inflation target, if 3.5% persisted, we would want to be raising interest rates. Now, just one thing to note about this particular number. This number was boosted up by food inflation. Now, food inflation is important. Don't get me wrong. Particularly among the lower LSMs, basically people that earn less money. The less money you earn, the more likely you to spend a larger proportion of your money on food. Someone that's making millions a month is not going to spend 10% of their income on food. Someone making say 5,000 rand a month is going to probably spend at least 10% of their money on food. Okay, so if food inflation is high, it's going to affect the person making 5,000 more than it affects the person making $1 million. But the thing to understand about food inflation is that it's really dependent on things like, for instance, the weather, feed prices and so on for chicken and beef. And by the way, but this time around it was beef that was a problem. Chicken and eggs were not that much of a problem. In fact, they were slightly positive in terms of like the impact on bringing inflation down a little bit. But food inflation is really dependent on things like weather. People don't change their consumption habits for a 1% or 2% interest rate adjustment. The way interest rates are supposed to work is it's supposed to make it more expensive to spend money and therefore reduce demand and therefore reduce prices. Food inflation is not going to be affected by a 0.5% or 1% interest rate rise or cut. People are not going to change whether or not they eat beef or not based on interest rates going up 1 or 2% or coming down 1 or 2%. And like I said, it really depends on weather. And I want to bring in a little aside here. We expect weather patterns to be more erratic going forward. To give you a bit of an idea of how the world kind of works, there's major food producing areas, and food baskets, bread baskets, they call themselves. And these things are dependent often on weather patterns. They plant in the rainy season or whatever. Like the monsoon, for instance, really is important for global food production. As temperatures rise globally, and that's global warming, whether it's human-made or whatever you want to call it, we are going to see disruptions to these weather patterns. The more temperature rises, the more these weather patterns are going to be disrupted. There's a possibility that as these weather patterns get disrupted, you can find one of these areas failing in a given year. So, in fact, if you're basically planning on planting in, say, the Midwest, and as rain comes in, that year rain might not come in. You might have a drought, which would affect production. You might want to plant in India, when the monsoon season happens or whatever, and that monsoon fails that year, and you're going to have a failed crop. That happens. The way it usually occurs is that one of these places fails, the other areas basically produce, and you import food. If however more than one area fails, then we might have a problem. As temperatures rise, we're going to probably have more than one area fail, the chance of one area failing increasing over time. I think around 2%, a 2-degree rise in temperatures, the chance of in any particular year more than one place failing is in excess of 1%. So in the next century, that's a very high chance we're going to have multiple areas failing in a given year, which would be very negative for global food production and could cause food price hikes and, in fact, in some of the poor areas, famines and so on, just as an aside. But getting back to our problem with South Africa, that food inflation number not really dependent on interest rates. What we are seeing, however, is that there are other sectors that are more important when it comes to the long-term inflation in a country like South Africa. The one thing we do know is that in South Africa, government-rated inflation, electricity prices, rates, and so on, are significantly higher than the private sector inflation. And if you want to bring a rate target down to about 3% in South Africa, you would need to have the government basically agree to cut that inflation rate. Okay, they would have to agree not to have price increases for electricity of in excess of 3% or so. And we've had significantly higher than that over the last decade plus. You would have to have rates and other fees and so on by government not increasing by more than 3% on average. And that, I think, again, is a problem. We're not likely to see that to happen at the moment. The government needs revenue. Government wants to get as much money as possible. With other issues, so that number one makes it, difficult to see that 3% target being hit. The private sector inflation is also above 3%, but not as much above 3% as the government sector inflation. And you can argue quite, convincingly that if you had government inflation at 3%, it would reduce some of the inflation in the private sector just naturally, because private sector inflation, to a certain extent, is also, being fed by the government inflation. If electricity prices go up, for instance, and you're producing something in a factory, your costs are going to go up, and your inflation or the price you're going to charge to consumers is going to go higher as well. So if you reduce inflation on the electricity side, you will reduce inflation on the factory floor side as well. So that is, I think, to be considered. But like I said, unlikely to happen in South Africa with the current need that government has for, income and so on. The next thing is that if we do get it down to 3%, the impact on the economy would be quite strong. We would reduce the cost of borrowing, not just in the private sector, not just for basically, but also in the government sector as well. In the private sector, it's not just about consumption, but also investment. People would be able to start a factory, build invest in capital equipment and so on at a lower interest rate, and therefore make some more money. Also, make more decisions that are in favor of investments as opposed to putting things off. In the government sector, government debt would be easier to service if the interest rate was lower. One of the reasons that the worst country in terms of debt is able to have such high debt, that's Japan, is because their interest rates are so low. Okay, therefore they don't have a huge debt burden to service that debt. But if interest rates were higher, they'd have a much larger burden. If we get 3%, inflation targeting in South Africa, we would have significantly more affordable government debt, and hopefully that would mean that we would actually pay that debt down, but more likely it means we'll borrow more in the future. But that is the thing around our current situation. Now moving on to Intel. Intel, for those that don't know, makes chips. Until very recently, was the dominant chip maker in the world. I mean, it was Intel and there was AMD second. Now, in recent times, NVIDIA has become the most valuable company in history. Over $4 trillion in valuation has been hit. This is quite surprising considering like Intel had this lead for a long time. However, Intel has kind of fallen behind. Now, the US government has come in and said they want to take about a 10% stake in Intel in exchange for some of the grants they've given to the company. We've also seen a $2 billion investment by a company called SoftBank from Japan. And I'll talk about SoftBank in a second. Now, the thing to understand here, this is not how the US operates normally. The US government doesn't take stakes in companies unless, like with the bailout around TARP and so on, where they took a stake in, for instance, some of the automakers, but they then sold these things off. They took a stake in the banks and they sold them off. This is more third world industrial policy that we're seeing from the US, something that you'd see, for instance, in some of the third world countries out there, where or even some places like Europe. I mean, let's be fair. A lot of European, companies do have effectively government stakes in their businesses and are controlled partly by the government. France, Germany are very, significant players in, for instance, the auto industry. Airbus in Europe as well, also important. The Chinese do a similar kind of thing as well. Now, the question is this something that is, just a norm that the US is returning to, or is the US going to be losing some of their, unique spark that they've had? Remember, the US is the world's most dynamic large economy. Yes, the Chinese have grown faster, but they're coming from such a low base that, they're still, not making as much innovation as we see in the US. There's a reason that the AI stuff started in the US. There's a reason that NVIDIA makes chips that the Chinese just can't compete against. The US has a special sauce, a special ingredient in their system, and the question arises: is that what they're doing right now with Intel, is that going to dilute that to a certain extent? I do think that this is not the right way to go about things. The US has always had the ability to create its own production, etc. I do think that competition rather for different companies. And you can imagine back in the day, if when Apple was like basically getting its run up, the US decided to take a stake in Microsoft and basically support Microsoft. Would we have had the iPhone, we'd had iPad and so on? I don't think we would have. And so I do think this is negative from that point of view. The argument to be made against it is that chip manufacturing is so important. It's basically all dependent on Taiwan at the moment and TSMC, that the US has to do something to basically boost up local chip supply, or alternative supply, however you want to say it. And if you were to take out Taiwan, remove Taiwan from the global map tomorrow, Intel would be the leader easily. Okay, and so it might just make sense from that geopolitical point of view to just support Intel to make sure that they can kind of catch up to like TSMC, NVIDIA, and all those kind of guys combined, in order to basically provide some stability or some alternative supply in the event of, for instance, Taiwan taken off the map, or more realistically, an invasion by the Chinese. Okay, that could be the argument there. Next, moving on to SoftBank. SoftBank's looking to put about $2 billion into Intel as well. Now, SoftBank has made promises like this in the past. I personally am not really a big fan of some of SoftBank's investments. I mean, they've made some very good investments, Alibaba and so on, really good investments. But if you look at, for instance, some of the like presentations they give to them to investors and so on, it's really like quite unusual, let me say the least, non-conventional. Masatoshi Son, the guy that runs SoftBank, is a bit of an a maverick individual. His investment strategy is often based, on feelings or trends and so on. And he, sometimes hits it out of the park like a Alibaba, but sometimes does not. We've seen, for instance, with his investment, inverted commas, into, what OpenAI was doing. He does not quite have the funds. He has billions, but he may not have the hundreds of billions that sometimes he promises. And I don't think that longer term, a $2 billion investment by SoftBank is really going to be impactful on the ship space. Considering, for instance, that the big competitor there is like Nvidia, with its $4 trillion or $4,000 billion, valuation. Okay, that's for this week. Thanks for joining me. I look forward to speaking again next week. Cheers.